Good evening, delegates and the speaker for the day, Shantanu Mukhopadhyay sir. It's very heartening to have you here today for 3 hour session on project finance and financial due diligence, which is one of the very important topics for the present times, because we have been seeing the courts questioning the CAs, authorizing or attesting the project report, and also the auditing standards, whether you can sign the projected balance sheets or not, and also the importance of these for the banks and other finances and all. So even though there is some slowdown in the economy, and this is the core area of practice for the chartered accountants, so to update us on this, we have today Shantanu Mukhopadhyay sir, from a senior chartered accountant from Kolkata. A very warm welcome to you, sir, on behalf of SIRC ICAI. Thank you for accepting our invitation, and I very warmly welcome all of you, the delegates, and I also thank the chairman of SIRC who could not make it today for this webinar to be here in his absence here for choosing this topic. Before handing over this 3 hour session to the speaker, there will be a break in between for at least five minutes or so, and I take the opportunity to introduce the erudite speaker for the day. Shantanu Mukherjee sir is a chartered accountant and also a cost accountant, and a senior corporate experience and consulting exposure of 42 plus years. 42 plus years for your information. He has worked for business segment leader in MNCs and Indian houses, and he is a director of Bell Service Private Limited and a consultant for last 15 years. A senior VP Finance in ICAI Limited after merger, and ITC Classic Finance Limited subsidiary ITC Limited. Held the post of senior GM Finance in Dunlop India, promoter director on Bell's Services Private Limited, involved in KPO, which services accounting and taxation matters for overseas clients, evaluation of tangible and intangible assets of corporate, and consultation on implementation of IFRS in corporates, accessing project finance for clients, domestic as well as overseas, involved in unlocking value of stressed assets of corporate through asset realization and rehabilitation schemes, and promoter director of Bell Services Private Limited, overseas support system with banking software like Link24 and Finacle on pan-India basis, responsible for developing merchant banking function to support issue management, sourcing of PE funds and M&A, conducted and established HR support system at multi-million dollar Bangladesh company KDS Private Limited, and ITC Classic Limited, Dunlop India, and other and extra interests in addition to serving the units abroad, are ex-regional president of Indo-American Chamber of Commerce, ex-honorary secretary of Rotary Club of Kolkata, based in Asia, oldest in Asia, member in Kolkata Club Limited, have been speaker on management program in various seminars, including one organized by Hyderabad Staff College, have been a speaker in ICAI seminars on financial modeling, IFRS, etc., have traveled internationally and have worked in the UK and in Singapore also. So this is the very illustrious career of the erudite and experienced speaker for the day. We are all lucky to have you here today, sir. Thank you very much for your time, and we are very eager to learn from your experiences and also the updates for the present times. Thank you, and over to you, sir.
Sir, thank you, Mr. Panaraj. It has been absolute honor to be invited here because this is one of the most flourishing regional institutes that we have. And, you know, I'm delighted that I am here as a speaker for this very important subject. So the way I want to take this forward is that I would like to get into the skin of the subject and give the logic, the process, the thoughts rather than pure calculations, because calculations, all our chartered accountants, they're all supported by Excel sheets, so it doesn't matter. So I'm going to give you more on the logic part, on the cautious part, and what I've seen. A lot of things have come out of my own experience. So this is how I want to proceed. Of course, it's a 3-hour session, so I would request the participants to relax, because I don't want to bore them. So I'll have to take them carefully with breaks, so they also find value in the whole thing. That is the whole idea. Given the situation, we can commence as you feel. We can commence immediately with the understanding that Q&A sessions probably will be at the end. In between,
Yes, sir.
Mr. Selva will collect and give me the questions.
Sure, sir.
Is that right? Is that okay?
Yes, sir. Yes, sir. We'll take it up that way, and we can start sharing this concept.
Right. Okay. Thank you.
Thank you, sir.
So I'm bringing the PPT slide from where I'll speak, and I would request patience from my audience. It's a 3-hour session, so I'll take you through a lot of impacts of the project finance as well as the due diligence. So let's commence. All right. Let me get this PPT in position. Okay. So this is what I do.
Yes, sir. Now put it in slide. No, it stopped again, sir.
Oh, sorry.
Yeah, visible now. Now you put it in slideshow, sir.
I'll put it in slideshow. Okay.
Now
Is it visible now?
Yes, visible, sir. Please start.
And am I audible to everyone?
You're audible and visible, sir.
Okay. Okay. So let's commence. See, let me start by saying project finance is all about asking for the money. You got to ask the financial institutions, you got to ask the banks, you got to ask the government, whoever it is, lenders, they need to be asked properly. And the best way to ask is to provide the best of the detailed project report. So this is really the foundation of project finance. So let's take a very close look what a DPR is all about. Now, before we go into the subject, I would like to provide some generic guidelines, and these guidelines are really coming out of my own experience over the long years. The DPR should generate a robust sense of business as to its products, its long-term viability, and clearly demonstrate the same through numbers. So what do I mean by this? The DPR should be strong in its beliefs, should provide the potential lender or investor all details about the product and service which the product the project will generate, and finally will clearly bring the numbers to show that it is worth it. DPR is like a good reading material. See, the sequence of chapters should be such that inherent logic is not disturbed or fractured. For example, the DPR should be prepared in a manner where one should first give the details of the project, the details of the caveats, the details which generate interest in the shape of the SOW, the promoters. That's how the whole process should be. It should be a good sequential reading material. For example, if you give the project in the middle, the promoter in the beginning, and let's say the supply chain somewhere in the between, it will totally confuse the reader. It has to be very well thought out chapter, and I'll take you forward with this. The entire DPR is based on logic and assumptions. There is a brownfield project where the actuals are there already, and you can grow from there. But I'm more interested in showing you the greenfield projects where there's no such project earlier. Here, the entire issue are the assumptions. The logic assumption should flow chapter to chapter without any fracture, and it should not be contradictory. For example, if in a chapter the data says that the market will grow by 10%, in another chapter it should not be seen the market to be growing by 5%. If the intention in the first chapter is to show the data will grow by with the purchase will be taken from Kenya, in another chapter it just should not be shown as South Africa. So these are issues one has to be very, very careful when preparing the DPR. Please note, the DPR is a cornerstone of project finance. Now, the tone of the DPR should at all time needs to be positive. So what do I mean by this? Of course, it has to be positive. Everyone knows it has to be positive. But, I have a reservation here. See, we chartered accountants are told to be cautious. We are told to be look at the downside first, because that's how our training is. Now, when you create a DPR, you have to forget this this trait and try to be optimistic. And I'm not saying optimism means that you go off the whack. You have to be clearly on an optimistic tone. Otherwise, no lender, no investor would be interested in you. It needs to be reflected in little sentences. Do not make any assumptions with too many subject to clauses. That will bring a lot of negativity in this. So one has to remain positive, and I've seen this happen. I've seen this happen especially when chartered accountants prepare DPR. There is that cautiousness which kind of derails the objectivity of the DPR. So one needs to be cautious, but I'm not saying cautious. One needs to be positive, but one should not go positive without reason. It has to be connected with the reality. The font and the size of the font should be eminently readable. Like any book, this is very important. Readability of a DPR should depend on the size of the font, the way it is structured. The graphs should be clear, and the legend of the graph should be without ambiguity. People forget these issues because that makes the DPR less readable, less likable. Please spend money on the paper quality. The paper quality should be top class. Do not scrimp money on the paper. You should use bond papers without any hesitation. Please remember, you're going for a project which could be worth 100 crores, 200 crores. Do not cringe on paper and save money. It doesn't make sense. I've seen this happen, and it's ridiculous. I've seen this happen over a period because I've been on the lending side also. Remember, another very important thing, when you bind the DPR, the cover should be attractive and should be connected with the system. And the the DPR should not, the binding should be such, the reading should be good. It's better to have a spiral binding when you can move the pages all around. If you do a staple binding, the reading would be difficult. These are very basic things, but everyone who is connected with the DPR should adhere to this logic. This is my submission. Now, a project requires fixed and working capital. What's so great about it? So this is what it is, and it requires execution on a time-bound basis. Entire DPR should focus, I mean, a good part of DPR should focus why it needs fixed capital and why it should requires working capital, because that is most important, the extent of fixed capital and working capital. Another issue that DPR should give is that it should be finished on time. There should be no delay. The delay in a project worries the investor. It is a bane the investors want to avoid. Now, having decided, the capital can be from internal resource or from outside line of funding or a mixture of both. It has to be a mixture of both. About 95% of the global projects are mixture of internal resources and external channels of funding. So a promoter must put in money in a project. It cannot be entirely from lending. This is true for all kinds of lending and more so for projects. Now, when I mention this, the equity part, and we'll get to the debt part later, the equity part can be from internal resources, or if you can get some P investor or a VC investor to invest. They will also only invest, of course, on the capital of the whole company. But they should have the confidence that because of this project, the value of the whole company will increase. Now, this is a virtual presentation, so I really don't know at this stage is this understandable from your end. So let me repeat it once more. Equity funding can be from internal sources of the company, or it can be from a VC who will invest in the share capital of the company, but will be earmarked for this project only and only when the company realizes the value of the equity as a whole will increase because of this project. The external channels of funding largely would be debt, and we'll get to that later. And India is following the global trend of 95% of the global project on this mode. The other 5% virtually funds from their own sources. You'll have Teslas of the world who will put their money on their own source and not borrowing because of a huge cash surplus. Apple does not take money from outside when they do a new project, but those are exceptions. Maybe Reliance also can afford that for a while. So having said that, let me also give you the variety of projects that happen and they require a variety of funding. Here, let me distinguish between greenfield projects, which is absolutely new and does not have a pre-run. Brownfield projects are existing production system where they want to enhance the capacity. Greenfield projects require a different kind of presentation, a different kind of persuasion, a different kind of risk. While brownfield projects are more within the system and may follow established financing patterns, probably unless it radically changes the existing pattern. Then we have got long-term and very long-term projects, which requires robust risk insulation. Once you have a long-term project and the period extends over a period, the risk goes up. Every project which has a long-term, there's so many uncertainties which come into it. As a very senior banker told me that at the end of the day, in spite of all the risk evaluation, we invest with a huge uncertainty over long-term period. You don't know what's going to happen. There are so many things that can happen which can change the whole thing. So a risk insulation factor should be built in such funding. For example, they can have a recall clause, they can have an interest variation clause, they can have um, risk-related review meetings every fixed period of time. They can in fact move the fund into equity if they feel that repayment structure is getting impacted. Is all the downsides come into play. Medium-term funds have multiple financing options because these are the best, easier way of doing things. Now, government projects and non-government projects are funded differently. Government projects are largely funded with soft loans, and government projects they are all infra and projects which are government directions and national importance. So they got soft loans, they got subsidies, they got government guarantees. So essentially, I mean, they go for funding to the same people, but they have GOI backing everywhere. Non-government projects also are funded on a collateral basis, on a cash flow basis. Let me also explain this thing very importantly. Funding from anywhere are surplus of cash flow over requirement. Collateral is only a secondary step. Collateral is a secondary risk insulation. No lending agency likes collateral to be invoked because there's a challenge sitting out there. So essentially, it is the cash flow which determines whether the project will be funded or not. And this is my understanding and this is my belief that in all projects, especially, cash flow is the king. You have a good cash flow, you can just go ahead. But if you don't have a good cash flow, even a lot of collaterals may not bring it to the table. I wish I could interact with you physically because I want your understanding of this, but I'm sure you will agree with me. Overseas projects have a distinct style of funding. You can get ECBs. You can what generally happens is, overseas projects, SPV is created where the funding comes from soft loans abroad, promoter funding, and this process is same except the lenders could be sitting abroad and there is a risk of exchange rate which keeps going up and down with overseas projects. So these are these cannot be these are inclusive in the sense that these are the types which largely happens, and these are the types where you require different styles for different kind of, horses for the courses. Now, who lends? Who lends in India? All banks in India are in B2B, B2C funding. But there are preferences. Foreign banks prefer short-term, medium-term project funding. And they prefer, additionally, those projects which has a lot of export potentialities. Why? Because the foreign banks gain a lot of money because they're robust in their export funding. So they get a linkage to the export funding when they fund such projects which is export potentialities. Just to make sure, am I being audible all around, Silva? Is it okay?
Yes, sir. Yes, sir. Perfectly okay, sir.
Okay, so okay. Next are the private banks. Private banks lean towards medium-term project funding, but more and more B2C lending is becoming their focus, the retail lending. The reason is simple. It is quick money. And if you open a lot of branches and if you have adequate people, you can do it. You see, project finance, unless it is done with properly, and as we'll see the various factors, can be very, very risky. So private banks are largely moving, or they do medium-term project funding. ICAI does, HDFC does, but they're more and more getting focused on B2B2C, that is retail lending, cars and home loans and all that. Now, so the bulk of the project financing is done by nationalized banks and GUI-owned stroke-backed financial institutions. Nationalized banks are, and in fact, where SBI is a king, does majority of the project funding in India. They have a process, national banks, they have forms, processes, which is actually nothing. When DPR is prepared and discussed with them, you can fill that up. So that is more a clerical work than anything else. The whole system remains as a proper DPR preparation. Similarly with the GOI-owned backed financial institutions, there is, as we'll see in the next slide, there are different institutions for different type of market. Now coming to the equity market. Equity is a great source of funding. Why? Because you don't have to pay back anything right now. So in a project, it can be a winner. Now who funds equity? It is the VCs and VCs and not the angels. The VCs actually get into equity funding. But let me tell you one thing. They invest on the total capital of the company. Even if it's a greenfield project or a brownfield project, they'll not invest. The project does not have an equity. They invest in the equity of the company. Now, there are two benchmarks. Equity market, equity vehicle will fund. Two major benchmarks. First, the product should be scalable. I'm sorry, there are three benchmarks. Product should be scalable, which means the product should be growing at a fast rate, which is why large amount of equity funding takes place in software industry, in high-tech industry, in industries which are new. In fact, new ideas, when the project comes, equity takes a greater leap than the lending. So to measure up to equity funding, one has to be scalable. The product needs to be scalable. Second part in this, since it's frankly a non-collateralized funding, they invest in the dream of the promoter. So the scanning of the promoters is probably 1/3% of their requirement. A good promoter, a good group, otherwise they won't fund. Because it is, as we'll see later, a promoter makes or breaks a project. And third is, of course, the profitability. And I must add in this whole presentation, whenever I mean profitability is more a cash profit than anything else. Because in projects, cash profit is very, very important. So as I'll keep saying, cash is the king. Overseas funding also used in certain cases, especially when the product is export oriented. You'll get a lot of ECP projects coming in, a lot of overseas loan coming in when the project is exported. This is the way they de-risk their funding, and especially in special purpose vehicles, these things come in. In a PE and VC funding are used in projects. I'm sorry, the only word is a wrong word. When a corporate curves out such projects, real estate companies, when they go do projects abroad, they create special purpose vehicles. Now, it is easy for PE and VC to fund those directly in the capital of the special purpose vehicles. An example, When Tata's went out and bought JLR, they created SPV, where a lot of PE and VCs funded to acquire that company. It was not the normal project, it was an acquisition project, but nevertheless, again, the same rules apply, that it should be a scalable product. The promoter has to be excellent. And of course, the valuation coming out of the cash flow should be proper. Let me run you through some of the important project financing institutions. Apart from banks, one is Housing Development Finance Corporation, which does housing and township projects. There are various state housing corporations which also funds them. There are various state financial corporations which fund projects. Various state industrial development corporations fund projects. Unfortunately, these are not very efficient. They have a lot of money, but their progress is very slow. So here there's a challenge that when you approach them, you really have to sit with them. You really have to make sure that they move fast. And the only way I can advise in this matter is that our team should be only working with them. They have a lot of money. They have a lot of agenda to slow, but they're very slow. One of the best funding companies for SME sector especially is SIDBI. SIDBI has been a phenomenal performance over last huge amount of years funding SME sector. If you have a SME sector with a good product, the first port of call should be SIDBI. SIDBI is quick, SIDBI is capable and moves very fast. This is my understanding. Now, a major project is coming up on non-renewable energy. Now, these are alternate energies for solar, for wind. You can approach IREDA. They fund the non-thermal energy projects. Again, such projects require special look, which IREDA is capable of doing it, because it is not heavily collateral based. And again, ultimately it depends on the cash flow, but cash flow could be over a long period of time. The government also supports non-thermal energy projects enormously through soft loans, and also for marketing of the same by paying these companies when they attach it to the grid. So this is another way of they get a fund. NABARD does rural agricultural products. These are excellent institution which takes care of rural agricultural projects. But the idea is same. You need to have a good DPR. Whether you're going anywhere of these, the DPR should be absolutely perfect. Then we have got Power Finance Corporation for power related projects. These are largely government to government projects. Again, a very efficient institution. Now, interest rates. Now, these rates are always risk dependent. Average interest rate today is 6.7% per annum, but based on risk profile can go up to 9.6. These are all medium to long-term loans. However, the tenor differs. If it goes up to say 20 years, the rate will come down. And of course, how you negotiate, how your risk profile stands up. Construction loans are preferred by government gives special facility to the banks and institutions. So they have a 4.5% rate, as low as 4.5%, again, depending on the risk profile. These are nationally important projects like roads, like bridges, like, like other similar things. So they are given at 4.5%. Construction loans and similar loan may be available. There could be, as you go on a long-term loan, most of these clauses have variable interest stipulation. So what does it mean? These loans are MCLR dependent, marginal cost of lending rate, which is which is a rate which is reviewed every 3 months, and is created based on the fund availability, the drag on the fund ability of the bank, the drag created by the CLR, the amount of projects in hand. So these are created every quarter, and the interest rate varies. MSME loan sector starts at 7.65. There's an inherent risk in such sector. The inherent risk lies not only on the product but also on the management. Let's understand, we are all sympathetic towards MSME loans, but MSME loans, you have to realize, do not have the expertise, nor the management is, let's say, that stable or that well known to get a low interest rate. So it starts only at 7.65 as of now, and well over the MCLR, and can go up to 9-10% depending on the risk. Interest for real sector is around 10%, but it's going to drop because of the slowdown of the economy, and the real estate sector suffered enormously. So a lot of banks, in fact, Yes Bank is one of the banks which suffered by lending to real estate sector. So there's a high risk profile sitting out there, and it's around 10%. Around 10, it can be lower also. Now, again, let me tell you, what are these interest rates? These interest rates are premium on the MCLR, which I mentioned earlier. MCLR forms a base on which risk determines the premium. It can be industry risk, it can be sovereign risk, it can be corporate risk. And these are reviewed every quarter. I mean MCLR, but once, of course, it is plugged in, it remains so. But they generally have a interest variable stipulation clause, which varies the interest over a certain benchmark period. I would like to specially mention BOT funding. Build, operate, and transfer projects are long-term projects which have public infrastructure support. So typically, the corporates create a SPV to host such projects. Again, typically, for example, you have building a road in a public-private partnership when you're not going to get a revenue for a considerable period. So the project owner is taking a lot of risk getting into it. Now, these risks are recognized by the GOI and lending agency. So the following are provided. A subsidy is from GOI. The subsidy is fixed and is given on a turnkey basis. Soft loans from FIs with interest holidays and also repayment holidays. The reason is, for a long period, the project owner is not going to get any revenue. So you have to match his cash flow with your own income. So that's how it happens. So soft loans are given with interest holidays, and the holidays typically terminate when the income starts, cash flow starts. GOI also give guarantees which enable accessing loans from other financial institutions at easy rates. When a guarantee comes from the sovereign of the country, the banks are easy, the lending institution easy. They generally will give loans at easy rates, and the interest rate can be as low as 4 to 4.5%. But again, let me also emphasize, while guarantee is fine, the collaterals are fine, it is the promoter's profile which will be of paramount importance in a BOT. The BOT operations do not go to companies whose profiles are yet to meet the benchmark. So the business profile, the promoter's profile, has to be first class to go into BOT. In a BOT, when the collection commences, directly certain percentage goes to the lender on a regular basis. This is done through an escrow account where the monies go, when the amount goes, and it gets distributed to the loan account and to the project owner. This is only fair. I mean, a lot of people I know have tried to comment and state that, why not come to us and we'll pay. One has to understand that the ones who are giving security, or giving this subsidies and risk mitigation, are themselves at a risk unless they are assured of a collections directly going to them. So in spite of all the hassle, it has remained so. And BOT, mind you, if generated properly, can generate huge amount of profit when the transfer takes place. So there's a risk and reward. I mean, what do you do? Off-balance sheet items. See, this is project owner often has to provide bank guarantee for performance as well as for lapses. So, project owner, and by a project owner I means the company, or that's what the company is, must have a good profile with the bank or lending institution to generate bank guarantee with the least amount of deposits. I mean, if a bank guarantee comes with a 10% deposit, it means only 10% of the money is blocked. There are companies whose risk profile high and the bank guarantee can go up to as high as 100%, which makes things very difficult. So project owner, when giving, must have a good profile, must have a good working with the bank. So they have a good internal credit rating of the bank to give a bank guarantee with if almost a zero deposit as a part of their facility. Okay, the lenders, what do they provide? They provide apart from the term loan and working capital, they provide as a part of working capital LCD, LC facility for purchase, comfort letter for better terms, BG facility for operations. All these above emerges from the evaluation of the DPR. So again, I'm pushing you back to the DPR for the simple reason the DPR is more and more important, and probably will have to be understood in a proper, and we have to really spend time on the DPR, because that is where the entire funding requirement is spelled out. But before we go to the DPR, I just wanted to run with this. This is also my experience. The project owner, before he lands into a project, and must evaluate his own self, because otherwise the DPR will get constrained unless he is very sure of the following. He internally must answer the following questions. Does the project align with the goals of the project owner? Let's say the goals of the project owner is to acquire, let's say, 10% of the market share of the product. Does the project enable him to move in that direction, or it's a minuscule development of the goal, in the sense that the market share may not increase properly, in which case he has to realign and see whether it's achieved. Now, also, expertise of the project owner should be such that he should be comfortable with the project. What does it mean? In healthcare projects, I have found that people who are from medical profession see the project with a better manner, more clearly. You can always hire managers and MDs, but there are projects like healthcare, like mining, where the project owner's expertise enable the project to move forward. Also, the project owner must, at the beginning, discount the cash flows and see whether his weighted average cost of capital is achieved and surplused. This is an internal evaluation that a project owner must do, because otherwise, a lot of projects happen on seeing others doing similar projects. I don't know whether you have come across this. Suddenly a product or a service looks very profitable, so everyone gets into it. Please, when you evaluate, when you look at such projects, you must understand such projects will have a difficult leg to stand on unless the project owner is convinced himself. And this is something that needs to be understood. Even as a consultant, we must make the project owner understand. The project owner must not get into a project which has high obsolescence factor. It is very difficult to project, I understand, but they must make a clear scan to see whether the product is having obsolescence factor. And with these days, the environmental friendly concept is very, very important. The project, if it's not environment friendly, the project owner must give second thoughts whether he should go ahead with the project or insulate the unfriendliness by giving more and more, let's say, processes by which project environment friendliness is achieved. I will come back to a point called ESG at a later stage, and that's a future of the project financing, which is not acquired that much importance as of now, but way things are going, it will. Now, coming to a brownfield project. You have got existing setup going also. So you normally the DPR will follow the existing rules, policies, but the project owner must see whether the increased capacity generated out of this new project will have a long-term sustainability. Many projects have come under the hammer because of excess capacity all across. You have seen steel, what happened in steel capacity when, for the heck of it, people have got into steel because steel was very profitable, and it went through a very long bad phase over I think close to 10 years before it revived for a while. Also, do not get into the promoter should not get into a project for prestige sake where servicing the overall cash flow becomes negative for the whole company. It happens. A prestige project often brings in a lot of negative impacts all around. I wouldn't like to mention Tata as an example when they took over JLR, but it did create a lot of pressure on their profits before the steel started picking up again. You'll have project owners getting into a project thinking it'll work out well, become a higher capacity. When the capacity lags, it brings down the entire value of the company. Other thing is, should we do the project or should we take over a company which makes similar sense? So this is another view a promoter must think of before getting into a project. It's a make or buy decision. Often taking over of another company with similar products makes sense. You see, Infosys has consistently followed this policy. Instead of building a new product, they've taken over companies which is making similar products. A lot of companies follow this and they gain benefit out of this. So the first step in creating DPR is creating a techno-economic value report, which forms a part of DPR. A lot of people think that is the DPR. That's not the DPR. That is a significant part of the DPR, which we'll see the contents. Okay. Now, Mr. Silva, are there any questions coming up which requires answering, or do I keep going and then take question later?
One question says that does DPR means a detailed project report?
It does. Detailed,
Yes.
it says detailed project report. That's right.
Maybe asking for
And
abbreviations of some thing, and maybe it was already self-explained in the PPT itself. It hopes so, sir.
yeah,
And some
yeah,
were
yeah.
asking for PPTs, and as of now, not much question on this regard. We'll go
Okay.
ahead, sir. If there is any.
Okay. 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 Now, again, let me repeat again. And this is where a lot of mistakes, a lot of people get confused. In a DPR, the techno-economic viability report is a significant part, but it is not the full thing. It's not the full thing. And so kindly concentrate as I tell you about the TEVR, which is a very, very important part of the DPR. Who creates the techno-economic viability report? That is also something that I need to mention. It cannot be created by chartered accountants. I am absolutely clear on this. The techno part must come out of domain experts. If it does not come out of domain experts, then the viability report will be weak. I can guarantee you that it will not be worth its salt as we go along. So you need to take in domain experts or consultants who have multiple domain experts to create the DPR. So let's start with the contents. Now, these contents are not all inclusive, but these are clearly the main important contents in a TEVR. All right. So now, first is the industry. The project creates a product or service which, or multiple products or multiple services which cater to, which form a part of the industry. Or automotive cars will be part of automotive industry. A steel production with a flatter curve will form a part of steel industry. So it's very important that the industry must be scanned first. So a TAVR unambiguously must tell what is the usefulness of the industry. It's very important. If the industry is not useful, if the industry is on the sidelines, it cannot have a long-term growth. Now, by stating this, I am also acutely aware that a lot of industries look great at this point of time, but may fall off later. I don't know whether you remember, there was equipment called pagers. When it came out blazing, and everyone was very happy. And I'm sure when they gave a TEVR with a pager, they got funded also. But look, they kind of, the usefulness changed because the quickness of the information moved to mobiles and now to chips. So one has to really look forward. Of course, it's useful now. Of course, you can say it's useful, but can we say it will be useful later? That is a question that we need to answer in a DPR. Now, when you go into this usefulness, you'll also have to go into the growth curve. Industry follows a growth curve. When the project starts, it cannot grow on its own. It must follow a certain amount of industry. I'm not saying it has to follow exactly the industry curve. If it is good and efficient, it can go well above. But industry curve is a pattern that cannot be ignored, right? Uh, Again, when one states the growth curve of past, one can state so. But when it comes to the future, there are issues that come into question. How do we ascertain the growth curve of future? You know, this is a very lazy things people do, is to extrapolate the past growth into future. 10% growth for last 3 years, so next 3 years 10% growth. It does not, in my opinion. I mean, sometimes they get away with. In my opinion, it does not stand. Every growth curve must have a logic behind it. The industry's usefulness, its acceptability to the customers is the main growth point. You see, there are a lot of retail products which are growing exponentially. Why? Because there's a demographic changes taking place, and that is the usefulness, and the growth curve is based on the youth coming in more and using those products. Similarly, in automotive sector, it can very well be that EVs may be replacing the growth potential of today's cars. So one has to look at that option and look at the growth curve. Usefulness cannot go away. If it goes away, then the industry is going to die. I have a nasty feeling that in this matter, newspapers may be on a declining curve over a future because of information being all around given through phones and and your Googles. So a lot of in US, 80 newspaper companies have closed down. I'm telling you, the same thing is going to happen in India, is beginning to happen. So this industry, well, scanning must be checked for its usefulness. Now, let me tell you, while I'm stating this, no project owner would like to say that my industry is not going to be useful in future. But one has to be very careful. That is why before you get into the project, one has to think on these issues. Also, who are the important players in the industry? Do they handle majority of the market share? Can you imagine trying to get into a cigarette market with ITC being what it is? Can you imagine that a car manufacturer going into a present situation with the Maruti sitting on top? It can always get into it, but it has to create its own niche. It has to be a niche player before it becomes a all India player. So very important how important players are functioning in the industry. It is also equally important at this stage to state how they plan to capture market share as they go along. So a scanning of the important players in the industry must form, and their future plans, which is available often in balance sheets, can be a pointer in the DPR. Especially, let me tell you, this is the software industry is so fragmented today. Is very important that such scanning of the players are deeply undertaken at the time of creating the DPR, industry scan. Especially now, looking at the product of the company and the international reach, domestic as well international reach, is the market going to grow? Internationally, will it acceptable for Indian companies, Indian products, whether international competition can force the product to slow down, or it can go higher? I know an Indian company which went to US with a lot of hope and initially they did well till the similar product got stiff competition from Taiwan and now is in a lower scale. So both these things have, look, I'll be honest with you, these are looking at futures. So when you look at the current, you must give the current properly, but you have to keep looking at future, and we'll see what can be done. Now, does the industry have an entry barrier? What does it mean? Is the technological skill of the industry such that not too many people can enter, in which case you're protected. However, let's say in a marketing setup of retail, there's no entry barrier as such, except the size of the competitors. So it can become more and more fragmented, and which is so, it's very fragmented. At this stage, for the industry, one must state what is its critical factor is growth and prosperity. How industry is growing and prospering. An industry may grow not necessarily on its own steam. It may grow because aligned to other industries, which is also growing. It may grow because of literacy of the industry is also growing. It may grow because it is drawing in more entrepreneurs, younger entrepreneurs who is willing to invest. So, in fact, there was one point of time financial service industry grew phenomenally because of these factors. But as the competition becomes too fragmented, a lot of people collapsed. We must state what is the USP of the industry. Why is it desired so heavily? Why is automotive sector so important over the period? Why is the EV cars going to be so important? Let's state the USP of the industry. The government of India support is given for the industries which are nationally important. Agro industries get a lot of government of India support. Infra industry gets a lot of government of India support, but you will not get GOI support for entertainment industry. So the tea industry that the teaware belongs must scan these points and well articulate their positions. Now, other point I wish to mention, and this will be a recurring theme right through, is that information needs to be supported by data and news from independent, reliable sources. Please understand, when you're talking about industry, you just cannot say that, "Hey, I find the industry very good, is growing." No, it has to be a third-party verification coming from independent sources, not a source which is reliable, unreliable. Government source is very good, and I'll tell. And as we go along, we'll talk about this, because creation of a DPR, and here I must also say, a DPR creation which ultimately goes into financial parameters is not just a financial work. It is a 360-degree encompassing work which finally merges into the numbers and give the figures. Okay, next important part is site. As you see, the details of site has to be given. Now, the point B that I want to mention is, why have you selected this site? What is so great about this site? Kindly mention. Why not anywhere else? The reason could be it is closer to the raw material, it is closer to the market, state government is getting subsidy, in agriculture sector the land is good for tilling, the availability of labor is there. So all these factors must be clearly articulated. But again, this articulation must be supported by data from an independent source. You cannot just state that this is it and expect everyone to agree, because look, you're looking for crores of funding. One cannot be lazy. One has to be really work on this. There are companies that only create DPRs, and they are working almost 24/7 on these issues. So, but I must warn you also. I've seen companies who are selling DPRs, who are selling techno-economic value reports. I think that is a very wrong way to approach. A TEVR must come from your own belief, your own strategy, your own desire. Then only it will show up that yes, this person can be trusted with the funds and the money can be lent or invested there. I'm not denying that the making of standard TEVR makes it quicker, but one should not go into quick solutions, but proper solutions. You must state the ownership of the site, who owns leasehold rights, who preferably give the documents. There should not be any doubts on this or any caveats to this, because then the investor will hold his entire funding until such caveat is cleared. Plus, such land should not be in areas where it is not, there are protected areas across India where tribals are protected, forest is protected, so it should not be there. Also, the site should have a backup plan. As if you want to expand, then what happens? There should be a backup land available. I'm not saying every time, but possible backup plan gives you a better way of going forward if the project succeeds. And finally, the point that I mentioned, that it should not violate any regulation and should be environment friendly. So what do you mean by, oh, we'll come to that. Yeah, I'm jumping the gun. So again, Mr. Silva, any questions, or should I go along?
No, sir, check it out. So there are 2-3 questions. I will just share my screen, or else how is it? So you will take it up now itself, or else we'll take it up at the break time, sir.
Or I'll take a later stage. I'll take a later stage. Okay.
One, so
Are
just,
this,
yes,
yeah,
sir, please.
but are they? I mean, is there any confusion onto what I'm saying, or is it more?
It's going fine, sir. There is no
Okay.
confusion.
Okay, fine.
We'll take it up at the break times. I'll compile and keep the questions whatever there, and we'll
All
take up the
right.
questions, and then we'll break for 10 minutes.
Right.
Thank you.
Now, this is a technological evaluation. Correct technology is a must. Now, what do you mean by correct technology? A technology which is available, which produces the product with the best quality, and the cost is reasonable. You cannot have all three same. Cost may be higher, but you cannot compromise with the quality of the product. The other point that is very important is accessibility of the technology. Accessibility of technology means, do you have people who are familiar with the technology and who are masters of the technology, or do you have to buy it from abroad? This is the one question that needs to be answered properly in a DPR, because it is very, very important, because technology cannot be compromised with. Other is re-engineering. Now, what is a re-engineering technology? You take a technology from abroad on a finished product and you re-engineer it to suit Indian conditions or Asian conditions. That's another technology. And a lot of companies, I tell you, is doing this. Not all are legal, but they're doing this. They're getting a technology, then remodifying it, which is strictly not legal, but they go ahead and do it. Also, this projection should talk about future obsolescence. Now, let me be honest with you. How do you see obsolescence coming? Did Nokia know that they'll become obsolete in 5 years' time? Did BlackBerry know it'll become obsolete in 5 years' time? And with the coming of electric vehicles, I'm sure there'll be a huge obsolescence factor coming in the automotive sector. So, how does one go in the obsolescence factor? No DPR would like to state that technology will become obsolete. However, DPR will state that even if there's an obsolescence factor coming in, the technology can be remodeled to take in the new requirements. Now, whether this can be stated is something that the project owner and the consultant has to be properly state. It is very important that obsolescence factor is not left at the end. No one likes to talk about obsolescence, but it is there. It is sitting out there. You know, the amount of money companies lose, the bankers and the financial institutions have lost because of obsolescence. And mind you, as we see their due diligence, this is a very important factor. So one has to look at it carefully. You cannot run away from it. Do you have skills to apply the technology profitably? You need to know whether we have got people. If we have got reasonable people, can we skill them? That needs to be answered in the technological evaluation chapter. See, in a technology, if you have collaborations, joint ventures, where you can acquire the R&D facilities of such units, it's a great way to obtain technology. But they come with a lot of caveats. One of them is, of course, the profit sharing, the royalty, huge royalties payable, and export requirements to the countries. Outright purchase of technology is again the royalty arrangement is also proper, but they're large. So one has to be very careful whether we should go for purchase of technology or whether we should go for existing technology and remodel it if necessary. See, in Brownfield project, of course, this portion is not that serious because already you got a technology, unless you require a serious upgradation, and that is possible. So again, I'm going back. I am going back like a broken record to the obsolescence factor. One in a project, one has to look at obsolescence factor. Very important. You know, India had a thriving jute market. Banks lent heavily. Somehow the obsolescence factor was overlooked, and then even the brownfield projects collapsed. So technology must be stated about its efficiency, ability or skill, but at the end of the day, one has to deeply look at your obsolescence factor. And you see, technology is an area where developed countries make a lot of money. So one has to negotiate also for a good technology collaboration or purchase, because purchase of technology gives you proprietorship, but it comes with caveats. And you know, for example, there's another issue. See, even agro products, a lot of new technology has been developed by Japan. They are becoming available, but at a high price. So one has to see whether this cost meets the requirement. Now, let's look at evaluation infrastructure facility. The eternal question, whether you need to be close to raw material or close to market. The thumb rule is, if the raw materials are bulky and difficult to transport, remain close to the raw material. For example, steel. It remains close to the coal mines and other mines. And the market is there across the world. However, especially in a service sector, it is better you need to be closer to the market, where the raw material is non-bulky and often intellectual, in which case you remain close to the market. But a tremendous thing has happened, and this question needs to be answered properly in a DPR. Why are you choosing an infrastructure which is close to the market? You have to give the reasons. But you know, the technological developments have been such, often these questions have been rendered useless or rendered insignificant because of service project, especially in service project, because there the market may be US, you may be sitting anywhere in India and servicing it, and your people are there all across India, because thanks to the young crowd and the increasing literacy, this whole question has become redundant for this service sector, which incidentally is now 62% of your GDP. It's no longer a tiny sector. So, but still, the large in industries have to go with this close to raw material or close to market question. You know, there was a company called Ajanta. I don't know, Ajanta clocks. They left India to get close to their raw materials and move to China. Of course, they've finally closed down, but they decided to do that because their raw materials were getting costly. Power availability and its continued supply. This is a question that must be, as it's self-evident, because unless the availability of power and its continued supply is assured, having a project would be costly. You can always have your own power supply, but that also requires a lot of cost. You can build your own power supply. You can have a coal coming in and do it, but those are additional costs. So power availability and its continued supply is an assurance to the lenders that project is rightly located. Transport facility by road, by rail, by sea route, by air is also a very, very important factor to bring in the raw material, to bring in the people, to send it out to the market. But it should be also designed in a manner that risk is minimized. You know, I scanned a DPR which talked about road going into the factory. And when I visited, I found there was a single road going into the factory. I mean, that's how it was planned. And if that road closed, the factory closes all routes. So there should be multiple, at least two roads leading to the main road for transport. Similarly, the rail, there should be at least two stations, which are, one is a very close, another is somewhat close. It is preferable, the transport facility should also have a possibility of sea route, and of course, the best is also by air. But everything is not possible. So one has to make do with two things, at least two alternatives. Why am I stating so? You know, this is a downside of a project. You don't know what will happen for infrastructure. There could be a flood, there could be a strike, there could be anything. So the route should have at least two options. Otherwise, it becomes a risky project. Okay. Availability of skilled semiconductors and cheap manpower. Now I'll tell you again, the software industry and the DPR is gung-ho about this because skilled people are generally available in India today because of literacy. But not so skilled people when there are high-tech technologies involved. So for that, one has to make sure you may have to house them in your complex, and for that the facility should be there. For semi-skilled, it's all around, not an issue, but for skilled, especially very high skilled, you need to house them. Otherwise, you cannot, in a remote case, make them move from one place. They won't come. Environment friendly measures, what are you, the sewage disposal, what are the appliances using it to bring it down? These measures should be cleared in great details. Again, I'm repeating this because although I've not put it in the DPR as such, but I'll come later on a activity which is gaining enormous traction for DPRs. The activity is called ESG, and I'll leave it at that, then I'll come later. Because ESG is going to be one of the main focus of DPR in future. So as I told you, what are the environment protective measures that must be mentioned in a DPR? It is really wise to discuss them separately because you see, today you may have a great project profitably, you may have a great market sitting out there with a lot of growth, but you will never get funds if it's not environmentally friendly, or if you're not taking measures to make it environment friendly. You know, I was talking to a very senior person regarding the electrical vehicle production. He was telling me something very important. When the EV comes, it becomes environment friendly. So the DPR of a EV project will really tell you how good the project is environmental wise. But what it does not tell, that it requires more battery manufacturing in a place away from there, which pollutes the atmosphere. So it's just shifting of the environmentally unfriendly situation of automotive cars to a battery manufacturer who produces greater extent. So it has to be clearly stated how this is working out and what measures are you taking. What measures could be? I mean, this is just a suggestion. One is, if this creates disturbance with the natural flora and fauna, the DPR should state it will actively get into afforestations. If it erodes soil, the project, it must take measures for soil conservation. It must also state, wherever possible, to use non-thermal energy. Maybe wind, maybe solar, maybe thermal. You don't know. I mean, whatever is useful. So this enhances the DPR and gives a situation that you are a responsible player and you deserve the funds. Recycling of appropriate material is very good. If this can be done and put in a DPR, it is a fantastic way to display that you care about the environment. Now, I don't know whether you're aware of what is known as carbon footprints. In a large scale, if this can be done, you can actually generate carbon footprints which can be sold and money recovered. But that should not be the primary purpose of DPR. It probably is a fallout of the environment protective measures that you're taking. A simple thing, let me tell you, and this has nothing to do with DPR. The people coming to a project, say general manager coming in a car, the senior manager coming in a car, the manager coming in a car, generates polluting factors from 3 cars. What happens if they come in 1 car? This is how the carbon footprint is determined, and you can actually sell it and generate money. But that, again, I'm telling you, is icing on the cake and not a purpose of the DPR as of now. Capex planning. Capex is there for long term. So the need for major capex need to be stated separately. This goes along with the technology and the process of the work. See, when the CAPEX planning is done, the process of the work, process of the project is given out clearly. Having done that, it gives a clarity of the project, how it's going to work. Having done that, their timing for acquisition should be planned in the DPR, considering the lag time. You see, fixed assets cannot be acquired off the shelf. Those are only small fixed assets. The major ones, you have to place the order, they have to grow, you have to test and deliver. It requires long time, especially when you're bringing from overseas. So the DPR must clearly state that they propose to put the capex order in X date, expected to manufacture on Y date, expected to be inspected on a Z date, and delivered on a date later than that. This kind of planning needs to be put in a DPR. See, in case of overseas supply, especially overseas supply, you need to display in the annexures of DPR what are the negotiation documents, the emails and the letters. Now mainly email, no one writes letters. The quotations that has come with all the caveats that this has to be funded, it has to be paid in this X amount of time, this has to be paid in advance. All that has to be displayed as an annexure. Now, why this is important, I must tell you this. When the documentation was rudimentary or the information was not available as it is available now, unfortunately, a lot of promoters with dubious intentions inflated their capex purchase price and park money abroad. It is for this reason the capex price is deeply looked into and scrutinized, scanned. Now, does it mean it's not happening? It's happening. I'll be honest with you. But it has come down by, I would say, 70% is down. And one way of doing is to have multiple parties, quotations, and those multiple parties should be independent. It should not be a company floated by the promoter abroad. That will get found out and it'll be disastrous. So multiple quotations display that we have chosen this capex based on not necessarily lease price, but also the quality of the capex. But that consideration has been given. See, in case of technology tie-up, it's much easier because the technology provider often arranges for the required supply. That is their purpose. That is how they also make money, because they make profit there. But it eases the whole thing because you don't know the technology well enough to get the right kind of capex. I've seen this happen in process control equipments. When Honeywell came, they tied up with Tata, and the technology tie-up, it's Honeywell who supplied the entire machinery. Tata didn't have to search. Such things happen, and that's not a bad way of doing things. Now, the service contracts, let me tell you, the service contract must be deeply looked into, and the service providers must be scanned. A capex may go haywire if the servicing is not done properly. You'll find in large contracts, service contracts are equally important as much as the capex, technology, and availability. Look at the Rafale purchase that Government of India did. The service contracts were equally important given to various important people. So you must understand that this also is a very important part of the capex, and DPR must state clearly which are the service contracts, the service contract parties who have been chosen or they desire to do. Also the value and the terms of such service contracts. Every time this has happened in earlier, it has created problems because of what I told you earlier. It was what is known as overbilling. Now, financials. See, I'm not going to get involved in how you create a working capital, how do you CMA. That's all well known to you, and you're all top class chartered accountants. You've got help of Excel sheets, so that's there. Let's look at the underlying provisions by which you create the financials. See, and this is my view that assumptions before you create the financials should be clearly stated. It should follow the logic that we mentioned in the earlier sections, because frankly, financials is the cumulative thoughts that have come in after all these sections have been properly given. And frankly, it should not contradict the views generated in other sections. If it does, then the DPR falls. So that is why a DPR is a very, very intense exercise and should be stated. And I'm stating the reason is it is not necessarily the project is large or mid. Even small projects, same principle holds. The assumptions given in the earlier sections, the growth of the market, the cost of the product, the delay in lag time of capex happening, the service contracts, the ability of skilled labor, their cost, nothing should be contradictory to that. It all should be assumptions, should follow from there. Okay, the assumption must be logical and wherever possible should be based on reliable independent reports. I mentioned independent reports. It should be now. See, once you're looking at a future, I'll be honest with you. So when you look at a future, how do you look? You have to base your future not on the gut feel. I mean, project owner may have a gut feel, his senior people may have a gut feel, but gut feel will not get you funds. I can tell you this much. You must assess reports from CMIE. These monitor Indian economies. It's a very, very well-respected institute. Bloomberg, expensive, but it gives you a uh, fantastic look at the future and the let's say assumption and the growth that may take place, or a negative growth that may happen. Next is your yeah. If you look at the consultants like PwC, Deloitte's, EY, they come out with research reports on various issues. Take a look at them. They give you a very good idea how the market and the product will move. But I must also state that backing this would be the promoter's own research. He must have a research which goes with his gut feel before he acts. Just doing this won't do. And they must align in the assumptions. Then only you can state the market will grow at this rate, the cost will grow at this rate, the skilled people will be available, the expense will grow at this rate, and another very important thing is you cannot run away from the market. The industry must also will be having its own. Most of these industries have the association of their own industry. They come out with research reports also. So as I said, the marketing, the growth pattern, geographical concentrations is going to happen. It's going to happen all around. Price projection, all these assumptions must be given in the marketing. And these are not exclusive. I mean, these are important ones. Cost, productivity projection, price projection, labor rates. Now, all these would be coming out of your own research and the research the ones which I told. The interest rates could be assumed with variable rates or lower rates. It all depends finally on the risk profile that you provide. I have seen this another thing in a brownfield ventures. People simply extrapolate the past financials and create the report. I think this is a very lazy way of doing things. It does not make sense to me, because imagine if the same thing happened in a jute industry when it's doing well, how much money the bankers would have lost, how much money the lenders to steel people lost over the last 10 years if this was the way they exploited things. It has to be a research oriented. Of course, the project owner must have his own research, own gut feel, but this research has to be done in a very strong manner, and this is the bedrock of creating financial projections. Now, and this is again my view, that cash is the king. In a project, everything flows from cash inflow, outflow. Rest, all fine, but it is cash which makes it the king. So the cash flow needs to be created, and I prefer to do it not a balance sheet derived project. It should be more a income outflow method. So it needs to be done with assumptions and needs to display the growth as mentioned in the assumption, as mentioned in other chapters. Here, let me give you a caveat. We cannot, a DPR will be looking very bad, or rather will be looking pretty challenging if the growth is suboptimal to the industry. It is not a good way of doing it. The best way to grow a cash inflow higher than the industry. Now that would require a lot of thinking, and I think that needs to be stated. Otherwise, I can't see a project owner going into a project. The deficits coming out of inflow and outflow will give you the need for funding, whether internal or external. This is where how much fund you need is determined on a staggered manner, month on month, beginning of the month, the capex long term requires long term funds, rest require working capital funds, how much will come in security, equity, all these needs to be coming out of this gap. So this calculation is very important. The internally one must, as a consultant, must go through various scenarios to come at a proper one which can be stand up to scrutiny. I understand that a DPR has to be optimistic. As I told earlier, it cannot remain cautious DPR. But at the same time, it cannot be unrealistic. So this gap must be realistic gap, and I can assure you, the lenders will appreciate that when you put it that way. Say if the industry is growing at a 20%, and if you grow at a 40%, you have to give very, very reasons how it is. If it grows around 45, 47, perhaps it's not required. I have seen this with my own eyes, and the desire is to create a very, very optimistic, which gets separated from reality, and the DPR falls. Fund does not come. Or if they are told to diffuse it to a level to reality, waste of time. Normally, and I'm telling you normally, the 30% of the gap is funded by equity and rest term loan, quasi-term loan, or working capital loan. Preferably, the fixed part of the cash flow requirement is funded by equity, but often in nationally important projects, that 30% may come down. Now, again, I told you about the equity. It can be owner's own fund, or it can be invested in the company itself, and the value coming out of this project must be displayed to the VC or PE, because they go by the value basis. What is a quasi-term loan? Let's say a cumulative convertible debt. It can become equity later on a milestone basis, and it can create a let's say a cumulative interest which will not hit the cash flow immediately and keep the cash flow going. Now, the loan, what is the crux of the cash flow? The cash position prior to interest, the surplus prior to interest must cover interest payout of term loan and working capital facility, as well as repayment of installment liability. It's very apparent. This is where the whole issue is. You can play around with your cash flow on a realistic manner, but ultimately you must come to that. Ultimately, you must come that the surplus arising out of the cash flow covers interest payouts and installment payouts. This is why one of the points of negotiation is to get interest holidays and installment holidays. That matches the outflow with your inflows. When the project is long term, where the immediate income is not coming. And it happens. What happens with long-term projects, infra projects happen regularly. So my point, again, I'm getting to it, the surplus prior to interest and EMI facility or installment facility must be positive. A DCF calculation is preferably given to show a NPV which aligns with the goal of the company. If the entire IRR is, let's say, 10%, maybe NPV will give 12% return. That enables the lender to know that that the project owner is not only safe, but he'll be determined to create a project which is good. In all this, let me tell you another point that comes up is, as we'll go to that here of the due diligence, is that there should not be a delay in the project. Now that we will see through various factors. Delay in a project is not desirable, but one has to see it. Similarly, on a cash BEP position needs to be disclosed at what level the BEP is reached. If the cash flow is volatile, and it can happen in the initial stage depending on the industry, then one has to have a greater amount of equity coming in, because a loan, people who give loan are averse to giving people having volatile cash flow. Now, this is a part of negotiation, part of DPR. You see, how do a venture capitalists, they align the cash flow? They are not worried about volatility cash flow because nothing comes immediately to them. They are long-term players. If they believe the volatility of the cash flow is good for the company on a long term, they will put the money in equity. For that, one has to make very strong presentations and clearly give those points, the scalability, the promoters, and of course the profitability. Now, cash BP is very important to know what is the level at which it must achieve. It may not achieve immediately, but it must achieve over a period, on a reasonable period. Break-even points give the lenders measure of satisfaction. Now, question of equity or debt. When the cash flow has a balloon-shaped surplus, how does a balloon work? It has thin, when a balloon is blown, the front is very small and it grows into a large gap later, large thing later. And the cash profits have a balloon shape with a profit at a later stage, then a greater stage of equity would be preferable. Because equity is a long-term player and they are willing to take the risk of low surplus or no surplus to look at the large cash profits at the end of the period where the valuation will become high. Debt, on the other hand, is cheaper, easier to access, and leveraging on the debt can be a multiplier. This is true for companies where the waiting period for cash surplus is not too long. There, as the earnings get higher and higher over the interest payments, the profit becomes big. The reverse happens if the project struggles. Okay, now debt also requires excellent security, which projects must guarantee, fixed assets and working capital. That is why scanning of the capex and of the finished goods are very important. Now, what happens in case of service industries? Service industries cannot generate collaterals. Fixed assets, it can working capital, but that's largely the receivables and advances, if I may say so. What happens to the service in DPR when you create DPR for service industries? Service industry has to provide the DPR in a manner to state that the intellectual capital is good enough to take the company forward. That is the guarantee. The fixed assets are not enough. It is the intellectual capital which will take the company forward, and the DPR must assure the lenders that the intellectual capital will be acquired, developed, and protected. I repeat, the intellectual capital will be acquired, developed, and protected. That is how the lenders get assured. In any case, the project owner has to provide adequate guarantee, whether it's a corporate guarantee or it's personal guarantee. Personal guarantee also will be and a corporate guarantee. That provides a measure of safety, especially for debt, not so much for equity. Equity, let me tell you another thing, is a valuation game. So if the project does not generate good value over a period, then actually you'll be selling your equity at a low rate, at a less rate. So this is another factor that has to be built in while acquiring equity. Equity must be sold at a rate which is good for the promoter and good for the equity investor also. So the valuation part in this case, coming out of the cash flow only, valuation is done. So coming cash flow evaluation has to be done in a manner which generates a good valuation both for the promoter and for the investor. So income statements. The income statements are really cash projections adjusted for the credit periods of both payouts and pay-ins and inventory. Now, normally, again, I'm saying normally 60 days of receivables, normally 60 days of trade creditors, and experience credit 30 days is applicable. But it can vary from industry to industry, which will be stated by government, and one has to follow that. You cannot run away from those norms when you prepare the DPR. Otherwise, the working capital fund won't be available, because working capital will follow the CMA format, and that must be following these norms. Ratios are return on capital employed, return on net worth, debt equity mix, PBT by sales, interest coverage. This must be positive and sufficiently positive. Debt equity should also good. I'm sorry. BEP point, not cash BEP, it's an income BEP, and margin of safety. Margin of safety is another thing that gives the bankers a reasonable amount of confidence. Now, while I state this, the return of capital cannot be below the industry, at least over a period, neither return on net worth. If it's below industry over a long period of time, no one will lend because it's not worth it. Similarly, interest coverage ratio must be robust. That is where the bankers and the lenders feel comfortable. Let me again state a thing that I told earlier. Bankers may be getting a secure, maybe assuring themselves by getting a collateral, but that is a secondary aspect. They don't want to enforce collaterals. They don't want to go into a situation when the company has gone into haywire. They want to see the company prosper, that the interest is coming, and the principals are coming. That's why interest coverage ratio is a very important thing, which also arises from the extent of mix of debt and equity and the income. So it's all intermingled into this situation. BEP point is a safety point. Again, it cannot be too far away from the industry. And over a period, it actually must exceed the industry, be better than the industry. Exceed is not the right word, better than the industry. One must state SWOT analysis. This is a process which is, I find, very difficult. Everyone can talk about strengths. What is a strength? It tells internally what it excels at. It is a very internal thing. How does the project or the product separate it from the competition? Does it have a strong brand, a loyal customer base, a new generation product? These are the strengths which coming from internal working, internal acquisition of technology, internal ability to apply that technology, and mass of skilled labor, top class management. Next point, weakness. No one wants to give the weakness in DPR. Everyone feels weakness. Why should we give? It's a very challenging thing. I also appreciate what everyone feels. Weakness, no one wants to give, but that is a requirement. Now, weakness means, is there anything that the entity that is getting challenged and unable to perform? Say high debt level over a period. Is the supply chain robust? You must address these questions in a DPR and state that it may not be weakness if we take these measures. But you must give, and you should not give inane weaknesses. It must give genuine weaknesses that may happen over a period. Supply chain may get disrupted. So how are you going to address that? Opportunities largely refer to external factors. You see a new market coming up, a favorable exchange rate coming up, a new geographical location opening up. So these are the factors. You can take opportunities and go ahead, and everyone is happy to state that in DPR. No one wants to now put threats, even if they give weakness somehow. Threats no one wants to put, but it must give. It relates to, say, potentials that can harm the company. You have to be honest. For example, if demographic changes take place, your product may not sell the way it wants to sell. It has happened. Look at what happened when with the soaring rise of coffee demands because of demographic changes, the tea industry took a beating. So that's a potential. What happens if the labor supplies become tight? Why? Because of more literacy, the rates of the labor supply going up, and you are unable to access the labor at a cost. They are moving to other industries. The migration of labor from one industry to another is taking place. That happens only on literacy. So those are threats, but it has to be addressed. It has been told, yes, if this happens, we will look at alternative labor supply. This is what US did when they did the H-1B visa. H-1B visa enabled USA to get projects, the tight labor supply of US, they overrode and bought in similarly skilled, abundant labor supply from other countries and also cheaper. So these are facts of life. It has to be accessed, addressed also. Okay, now this is another very, very important thing. This is called sensitivity analysis. So it recognizes the interplay of fixed expenses remain fixed in all situations. Semi-fixed may vary to an extent, variable varies. So if you drop the cost or you increase the cost by 10% as a way of looking at it, then let us see what the bottom line is, how the cash flow pays out. If you drop the market by 10%, also increase the cost by 10%, let's see how it works. Here, one must address this question that fixed expense as a block is always a concern. The lesser amount of fixed expense you have, the better you are. And this must be highlighted across this segment, because often sensitivity analysis can run counter to the DPR. So you may have to go back and redo things if sensitivity analysis proves to be difficult. And yet this can only be done after the financials are complete. Drop the percentages, increase the cost, drop some markets, see what happens. These are the issues that needs to be addressed. Another very important thing I must mention, this is coming out of my experience. The greater the project has value additions, minimum is the negative volatility. Let me explain this to you. One product which assembles semi-finished goods from others and just assembles and produces. They are so dependent on the parts, on the semi-finished assembled parts that come, that any change of pricing in those creates enormous volatility and the risk factor goes up. Now, if the same company starts manufacturing from the raw material stage, it will have expenses, but the expenses are in their control. The volatility is reduced, the risk factor is reduced. The higher the value addition, more comfortable are the lenders and the investors. This is why in a retail, the ones who have very low value addition rarely get funds because the risk factor is extremely high. So they're so dependent on outside uh, production and activity that their own capability to handle volatility is reduced. Okay. Um, Now I must talk about the market separately. This is part of DPR, but I wanted to talk it separately. I did talk about market. Market is very important. Now, how does a market grow? Market grows based on demand. Market grows not only demand, but also higher demographics which are wanting that product. It also grows on shortage of supply by other suppliers. It also grows when the whole industry grows. So in a DPR, all these factors needs to be addressed separately in the market chapter. Again, the basis of these market are what I tell you, CIME publications, research of credit rating agencies come very important, research of 4-5 consultants, and as I told you, there should be a proprietary research also. Now, what I've seen in DPR is one tends to drop the negatives and go on positives. There's nothing wrong with that. Because at the end of the day, I don't want to give negatives in my DPR. But if it's so negative that it cannot be, it must be given with a caveat that how that will be addressed. See, a geographical market needs to be addressed very carefully because that's also interplay with the ecosystem of the geography. So one has to look at carefully at these geographical markets for projections, especially in an export market. Export market, one can be king and become pauper in 2 years' time. To make a sustainability, except the traditional things like tea, even tea is taking a beating. You need to be very, very cautious. You need to do a deep research on the market, which means interplay with other suppliers, other countries, exchange rates also plays a very role because differential exchange affects your profitability. So all these needs to be articulated very, very carefully, and the rationale of overcoming the negative things also must be told. For example, if it comes or it cannot be hidden anymore that there can be a dip in the demand in a sector, the DPR must state, recognize that, and say what additional service, additional add-ons that can be given to the product to combat that. A lot of these things happen in the automotive sector. When the dip take place, they give more features in the car. They try to give you a discount. They try to enable a better, they pay for the insurance facilities. So all these factors must be inbuilt in the DPR and from the market. You cannot just say everything is rosy. It will not happen. It will never happen. It will not sell also. So that is why extrapolating the industry or past is not the correct process because holes can be blown into it easily. Okay. Now, so where are we now? We are, okay, 7, right. Now I come to a area which must be mentioned in DPR towards the end is the promoter of his or her group. You see, after doing all this, you must give the lender or the investor assurance that the promoters are good promoters, efficient promoters, ethical promoters. They will not they will not run away with the money. As simple as that. This factor was somewhat ignored in earlier periods when, big names cornered most of the lending. But now with the spreading of the loans and the equity, scanning of the promoters is probably as important as a profitability and the collaterals, not only for equity, which I mentioned earlier, but also equally important for the lenders. So how they look at the promoters? What are the points that should be mentioned in DPR? The promoter part of the DPR must state what are the successful ventures the promoter did or his group did, which are well-known, functioning, and must be submitted with data. Another very important thing is it must be stated in a stress situation how it was overcome in the past. I must tell you this, that Google CEO, who is Microsoft CEO, Satyam Nadella, when he interviews people for very, very senior posts, he never asks them what are the success they've had in past. He asks what are the biggest challenges you've had. And once that is articulated, he says, now you tell me how you got out of it, what is the process? Similar to that, uh, a promoter's credibility should be how he got out of a stress situation, ethically, not in a post, not selling off or lying to the bankers or doing unethical things. It should also be stated how he's involved in the trade association, how much is involved in trade association, chamber of commerce, local government panels. This gives the authenticity to the promoter, that here is a person who is a genuine person who has been functioning in the trade for long and has been giving his views. So he is a genuine guy. Recognitions, whether he's got the best industry award or best energy conservation award from government or independent organization, not from his own people. Also, it may be stated how he has benefited society at large, done good CSR services, has been a member of human, member of organizations like Rotary or Lion, which has benefited underprivileged people. It gives a a picture of the promoter and his group, which makes him dependable, efficient, dependable, and not flighty, not unethical. It is a huge plus mark for for a banker or a FIs to invest. Key management personnel who will do the project, they need to be shown how efficient they have been, how their domain knowledge has been, how are the achievements, what recognitions they have had. What is the one reason this is done is underlying principle is the project will run properly. There is every term loan investor or equity investor in projects are scared of one thing: delay in projects. Delay in projects for reasons beyond the control, beyond is acceptable, but not the inefficiency, lack of domain, lack of sincerity. A key management personnel must be stated in a manner that such experiences are never to happen and shortcomings and delay of the project will never happen. That's a very, very important point. Now I will go into negotiations. Now this is something I have experienced myself, I'm sharing with you. When you take the DPR and when you sit with the FI people, what do they want? You have to understand the financial people like chartered accountants are cautious, basically. They appreciate honesty and transparency. And they're expert in evaluating financial proposals. So at all levels of engagement, and this is my theory because I've gone through this for X amount of years, is to first establish an open and sincere relationship with whoever it is, at whatever level. Get a feel of the person. It's necessary you get a feel of the person. Then the things will move much swifter. Next is choose honey over vinegar. What do I mean? Give the positive news over first. The vinegar, which is bitter, should be given preferably with bit of honey. But honestly, that honey has to be genuine. If you don't do that, I've seen it happen that people have this natural ability to sense if things are amiss, especially financial people who are used in evaluating financial proposals. So it's a balance. You have to remain optimistic. You have to give the good news, genuine news, and I'm not saying the vinegar should be hidden, but maybe it can be coated with a bit of honey. Like if it means that the export of raw material could be a problem because of uh, because of exchange differences, that may crop up. You can always say that we'll park in a SUV foreign a part of the export money and challenge the volatility of finance. So that will bring in the neutrality. So you have to play that game, and it's it's as a financial to access the money that is important. The other thing is true for all negotiations, that don't always seek what is in your favor. You have to let go something for the investors also. You may want everything, but you have to lend. Otherwise, negotiations will crack down. Also, respect the rhythm of the negotiation. I know what happens is project owner wants it does as early as possible, but don't push it. With the FIs and the people in finance, don't push it to a level that there's a any so that you get a panic on the roadblock. Take it easy, make it important, make it urgent, but don't push the whole situation into a panic mode. And finally, this is I always tell people, and I've been telling people all across, and when I told people in Singapore where they anyway dress formally for the finance, they said we do it, dress formally and dress in conservative colors. Finance people do not like people dressed in flashy colors coming with the DPR for discussion. Now, I think we are at time, Mr. Silva. Let's look at this way. I think we are now at
Yes, sir.
7:11.
Yes, sir.
Maybe we should take a break now before we go
Yes,
into
sir.
due diligence. Maybe 10 minutes of break we can take,
Yes,
and
sir.
you can send me the questions. I will reply once we open up. Maybe a 10
Yes, the
minutes break. Is that
questions,
right?
5 or 10 minutes break, and you let me know when you're ready. So I'll display break screen till then. And post that, I have compiled the questions, whatever that came up till now. We'll take up some questions and then go to due diligence if possible, or else we'll take it up at the end. Questions.
Okay. So, Mr. Silva, I go out of this and come back. Is that what
No,
you're
so
saying?
no. You just mute yourself and you
I'll
can.
just mute myself. Right.
Yeah.
Okay.
So I'll display my screen as well.
Right.
Thank you. Thank you, sir. I'm sharing my screen, sir, just for a break.
Mr. Silva, we can start again.
Can we start, sir? Hello.
Yeah, we can start. Yeah.
Yeah, I will just show questions. Is my screen visible, sir?
Is screen visible? Yeah, yeah. Now it's visible. Yeah.
Now, yeah, we have some 10 to 8 questions. So if
Okay.
we can quickly go through it, and we will go with the tutorial if possible. You can take the relevant questions, sir.
Yeah. Shall I state now? Yeah.
So your video is not
So
turned on, so can you turn on a video? I'll
video.
just
Yeah. Sure. Just hold on. Video. Right. Is that right?
yes, sir, visible, sir, please.
Okay.
I hope my Excel sheet is visible, so you can start taking the
Yeah.
questions.
So I'm just quickly running it through.
Yes, sir.
You see, it is possible. It's possible to do case study or draft DPR as guidance. It's possible, but with a caveat, you can get it from Google anywhere. But with a caveat that DPR, again, I mentioned DPR must come. You'll get general points, but DPR must come from inside, from the promoter. So as a guidance to learn, probably it's okay, but not to prepare. And the suggestions, that points that I mentioned, you'll not get in a draft DPR. You'll get bare bones. So perhaps that's a caveat. Yeah, there is one company, Chennai-based company, I forget the name, which creates TV reports. Maybe I'll mail it to when I find out. But again, I'm not very comfortable of getting standard DUP reports to work on it, because ultimately it'll be a copy paste job, not a job based on research and understanding. Industry data you get from the industry. There are associations of industry. Automotive industry, yes, you get from CMIE, uh, Consortium for Monitoring of Indian Industry. You just remember the CMIE. So CMIE will give you most of the industry data. Apart from that, you can get the data from the associations of very industry. Like automotive industry has a association called Atma. Atma will give you data for the automotive industry. Those you can access through Google. You can access through websites, but I think they have to be paid for. Yes, sensitive analysis is exactly that. You see various options. Once you reduce the sell price and increase the raw material price, but how much? Let's say you reduce the sell price by 10% and increase the raw material by 5%. See where the cash flow goes. Similarly, you see the overheads going up by 5%, but sales going up by 10%. See where it goes. So these are the various options. That's how the sensitivity analysis works out. But make sure that it is close to reality and not random. Market research reports, as I told you, one of the, as CMI is one of them. Other thing is Bloomberg. Bloomberg worldwide is one of the finest market research reports they give. But it has to be bought. The other places are various research reports published by Big Four or Big Five consultants. See, IMF and World Bank loans are largely sovereign loans. IMF can give to industry, but largely these are sovereign loans. Now, these loans can be for service sector, for upliftment of industry. Their interest rates can be as low as 2%. But largely these are channelized through the government. IMF loan is given also to industries, but those are industries which they are very keen on. For example, now the flavor of IMF is logistics. Logistic industry is getting a lot of IMF loans, and they come with the stipulation of very low interest rates, but they invariably have representative of IMF in their management. SaaS model is fine, but every technology cannot buy SaaS. So you'll have to, for example, process control, there's no SaaS model. The service project, look at it if I able to see. 7 is a very good question. Now, starting in a tier 1 city, you may be starved of skills or resources. So this is an area which is something that needs to be looked into. But more and more tier 1 cities are now, tier 1 cities fine, but tier 3 cities are getting into a problem. There's a merit in starting tier 1 cities, but those are for service projects. For factories, you can start anywhere. Service projects, I think it's largely tier 1 or maybe tier 2, but tier 3 is a tough thing. Sample of DPR, I can, but I can't show it. It's a huge thing. So probably I'll have to mail it later. You know, 9 point is a very good point. Everyone who wants to see DPR wants to see the product first, whether we are making profit and rest. Promoter comes at the end. But I agree with you. There's a merit of you asking for promoter at the beginning. In fact, when we do the VC, it's not a DPR. It's not called a DPR. It's called information memorandum. Promoters come first. For them, promoter is very important. More important than the security of. There's no security. So for them, promoter really comes first. But generally, in a loan mode, DPR comes at the end. But it's equally important. Doesn't mean that just because it comes at the end, it's no less important. See, this is my promoter. I agree with you. Promoter has a high weightage. The product also has a very high weightage. Product and its survivability, its lack of obsolescence has a very high weightage. And of course, the future market. These are very high weightages. So, Mr. Silva, can we move to the main thing now? So I think
Yes,
I've
sir.
answered
The
10.
presenter, right, sir? You can start sharing the screen. 1 minute. I switched to you. You can just click on show my screen so that the PPT on your screen.
Show my screen. Just a minute. Where no one can see your screen. Okay, right. Does it come?
Yes, sir. Yes, sir. Negotiations page is visible. Continue, please.
Yeah, so I'll have to minimize that, right? Wait. Okay, negotiations over. Now we go to the another very critical thing, that is due diligence. We have got time. How much time we have got? Over half an hour. I think I've overstretched this one. But a lot of these questions have been answered when we went through DPR. See, the financial institution due diligence on 2 parameters. One is industry risk, one is business and financial risk. So as I told you, industry risk, see, I must tell you another thing. Both FIs and banks, they have a huge database of their own. They do due diligence evaluation regularly. B, they have connect with research facilities. They have Bloomberg's. They have got own consultants who work on this. So for them, accessing data is not that much a problem. It used to be a major problem earlier when a lot of unethical businessmen went through because they did not have information. Okay. Now, first thing is obsolescence factor. Is industry subject to obsolescence? Yes, there's a factor that they scan it very, very closely. Now, is the industry facing a structural demand to supply mismatch? What do I mean by structural? It means that, for example, if there's a change in literacy rate of people, and this has happened, the BD manufacturing, you know what a BD is, the lower end of the cigarette. their demand drops. So that's a structural change. Is the industry subject to such structural demand mismatch? Now, this is another very important thing. Are the players industry too fragmented? I mean, are there too many players in the industry? So if you get into the industry, are you going to be one of too many? And your share of the market share is so fragmented, it can be risky. This happens when there are not entry barriers in the industry. What is the entry barrier? Entry barrier is your technical skill, your skill in supply of materials, your reach in the market. So if these are not there and the amount is profitable, then the industry gets fragmented. This happened 10 years back in the steel industry when it got fragmented. Now, is industry grows seasonal and products are perishable? That's a risk. So they look at it and they see whether the owners have made sufficient measures to protect the products from being perishable. And even in non-seasonal time, those can be delivered, which means good warehousing. Is the industry overtly UI regulated? You see, the healthcare industry, the pharma industry is regulated by government for the nature of the thing. Now, normally, it's difficult to get into these industries and get pharma industry to get project financing. In fact, most of the pharma industry, the ones who have succeeded, have been there for a long time. They have built on it. It's very difficult to get into this industry. So these are the roughly the couple of some of the points. There are other points also, but industry risk is something that one has to look into. Okay, there are more. Okay, now this is another thing. If the industry is dependent on supply of raw material or limited suppliers, it's a risky industry. If you notice, the chip from China did not come for quite some time, and entire automotive sector, including Tata Motors, went haywire. It's a risk because China was the only supplier. It's a sovereign supplier. Is supplier from countries which are somewhat unstable. Now, coal. The better part of the coal is supplied from Indonesia. Luckily, it has been somewhat stable. Had it been unstable, then any DPR creating steel related industry would be would look down upon. If the industry supplies products to other businesses like B2B, one has to see the health of the buying companies. Are they good? Will they take the demand for long? Will they pay on time? So this is another issue in the industry. Is the skill ability for the industry comfortable? It is self-evident. Unless the skill is available in the industry, it may not work. But as of today, India is largely skill comfortable, largely. But and with the growing literacy, things are becoming better and better. Is the industry perception negative? Now, this is something I must state. There are some negative perceptions in government as well as people, where taking a DPR and getting a fresh project loan is tough. For example, in a cigarette market, in a cigarette industry, it'll be very difficult to get a loan. It may get, but you may get a higher price because one doesn't know when the legislation may turn it off. And of course, the environment friendly aspect that has to be there. I must tell you at this stage, a very important point that I've been harping, I've not put it on the thing because it's somewhat futuristic, but more and more, the industry is moving to what is known as industry evaluation, is moving to what is known as ESG, environment, social governance. So what does it mean? It means that the apart from the profitability and other risk factors, it's a piling up of some points like environment. A company which is environmentally friendly, environmentally conscious, environmentally advanced in his production, in his daily working, not only production, daily working, in its ability to take care of environment in the future, will be valued better. Social is, what is the social interaction of the company? Is it benefiting the society at large? Are there factors this company is pushing forwards by benefiting the society? Whether it's human development, whether it's uh, literacy, whether it's healthcare, whether the company is doing additionally to develop society. Or I'm not saying develop, to help society. A company cannot develop society, that will be probably a government thing, but is it possible to, they are helping society? And G is stands for governance. How good the governance is. Is it, does it have independent directors? Does it have a whistleblowing mechanism? Does it come, whether the sexual harassment issue is properly handled and guidelines are put, whether the HR transparency is total, where there is no slipshod handling of safety of the equipment, safety of the people. So the all these three factors, they probably are spread all over this presentation, must come together as a ESG. And ESG, let me tell you, CRISIL already has started a rating of ESG, and it is seen the higher ESG factor companies are the ones who are doing better. World over, there's a recognition that ESG must factor into your evaluation of companies because they represent the best practices across the world. I know banks, I've dealt with a couple of Swiss banks, they are opened a separate, these are investment banks, they've opened a separate unit for ESG to evaluate their clients, number one, and to give consultancy to companies to enable them to adopt practices which advances them on ESG. There are companies which are now beginning to come up with ESG factor in India. I'm aware of a company in Kolkata which is doing it at a good job. They enable the companies to adopt ESG practices, which scales up their ratings across the world. So this is what I thought I'll tell you. This ESG is very important. So apart from pure environment friendly, as we go along, I think the ESG will become a stringent part of DPR. I have no doubt this is going to happen. Now, business and financial risk. See, if you look at the past, if it has grown by 5%, 10%, and taken a dip at 5%, is it reaching the end of its growth period? You may be showing an increase of 10%, 20% in future, but is it reaching an end of its growth period? Is obsolescence factor creeping in? It happened in pneumatic process control equipments. The same dip started, and over a period, electric variety totally obliterated its sale. So this is something the due diligence of the financial institution they look at. That are we looking at a situation that is reaching the end of its rising demand and obsolescence is coming in? As I told you earlier, changing of demographic is something looked into very closely by financial institutions to see whether this growth or whatever growth carries on. They also scan the competitors. Is the market too crowded for expected growth? The Indian FMCG market is a prime example because all the more entities who have come in after the market is consolidated are having modest growth because there are too many players in the market. The FIs and do not look favorably in such a situation. They look at future, and mind you, they may say, how will they know? Because they have a far greater ability to look into future. They have contacts, whether any government regulation is coming in the pipeline to hinder the growth.
Another thing they look into is, as the growth take place, does the DPR give you the bandwidth to take care of the growth? Does it give the bandwidth, means the support, the technology, the people? That is why, that 5%, 10% growth, people extrapolate, doesn't make sense. The growth of the market must be supported by the infrastructure of human and non-human to support the growth. Has the company has a desire to order greater capexes to take care of the growth? This bandwidth is an issue that a lot of people forget while doing the DPR. And this is where they got caught by the financial institutions. Export market is a great market, but international competition has to be, and the FIs scan this wonderfully. Because of their overseas branches, they get reports, they scan it wonderfully. And this is very, very true for our greatest export product, which is software. So many software products have fallen flat as the export competition has knocked them off. And I must tell you something which is very sad. Our software companies tend to make service exports rather than product exports. Service exports cannot sustain over a period. Already the black is happening. Why didn't we make products from the huge money that we had over R&D development? Infosys has realized that is buying over companies who make products, but the rest are not. And I'm not sure how will they sustain their revenue in future. It's a great problem, which unfortunately I don't want to criticize anyone, but I see that somehow we have not gotten into the race of creating products. Look at the companies in US. All great companies are product companies. Apple, Microsoft, Dell, everyone is a product company. No one is only a service company. Service is secondary. Most of our companies is reverse because of cheap labor, cheap skill labor. But that factor is disappearing, and we should have realized that. And this is where, when they come up with the DPR, they'll face this question. Okay. Now, while we may take the site closer to the raw material, can they be accessed comfortably? You see, there are local resistances also, which create problem. A lot of agro-based raw material can be a concern in this matter. You saw what happened in the farm laws. That could have been a great source of. I strongly feel they were good laws, and they could have been a great source of into the agro-based industries. But there are agitations, so one has to be very careful when the RM accessibility is discussed. Even in mining, the local issues are getting into the point saying that our ecosystem is getting disturbed. So while DPR will obviously not mention this, the due diligence by the financial institution will take care of this. They look at these issues like with a thread needle. They also look at the transport facility, which I mentioned, and 5 years in case, especially in case of imported raw materials. Why? It is very, very important. Okay. Now, import duty structure. Now, this is another issue that has to be looked carefully and needs to be discussed in DPR. Otherwise, you'll get caught by the financial institutions. A lot of these import duty structures are decided by government in various budgets. One doesn't know what will happen. So one needs to have certain leeway in the DPR to discuss. If it's not discussed, then due diligence will make you discuss this possibility of changing of import duty structure. Product having a high value addition. I mentioned this earlier. Low value addition is a risk because most of the inputs are outside your control. You are just probably converting. You see, this happens. I've seen this happen in Bangladesh, where the only value addition that they were doing was supply of labor. Entire raw material was supplied by suppliers from outside. They converted and sent it back to US for on a cheap on a Kmart and Walmart. They took this value addition was only the supply of labor. those projects do not get comfortable, let's say comfortable loans and interest rates, because it becomes very risky. If you don't have a high chain of value addition, that is your manufacturing process inbuilt in creating a product, it is always a risky game, and it's self-evident. Now, information technology is in information technology. This is a very burning question. Are we giving a technology for creating the product efficient or not? See, this is a question I want to answer, but this is a question I have come up with X amount of DPR concerning IT sector. And technology is become so important that for IT sector, they have to be always ahead of the cycle. So here the DPR must also state, otherwise it'll be picked up in due diligence, that their technology that they're giving is cutting edge, most advanced, and not anything that fall behind. In case of acquisition of technology, now the DPR will see how much it has progressed, because there are negotiations with the overseas people, negotiations with technology servers, and what are the caveats in a MOU with the technology people. There'll be X amount of caveats. The caveats are what? They will say that we'll supply at this price. We will not part with the entire technology. You'll be paying royalty up to a period of time, and then we'll part with the technology. They will have their own people here, which means you'll be dependent on the technology servers. Is it good? Is it bad? Which has to be assessed. So MOUs, GOI permissions, as well as legal constraints, all have to be submitted to the banks to do, so they can do this research. Also, to work on the technology, one has to see whether pool of skilled manpower exists at budget. It'll be always there. Skilled manpower is always, but at what price? That is to be seen. That what price it'll be seen, and the evaluator will look at this very strongly. Okay, now I think I'm running out of time. Yes, okay. Okay, now a couple of things a bit repetitive. See, on our overseas cash flow, let me tell you how do we do the risk insulation mechanism. One is taking a forward contract. Is it good or bad? How does it impact your price? Do we have LC facilities everywhere? What is the mechanism if the fund is not coming? And how is the exchange rate being forward, whether the forward contract mechanism is efficient or not? So these are evaluated and discussed. Now, the covering of interest and installment payment, if it just covers, let's say, X amount of money of interest and your surplus is X plus 1, it's not a good margin. The margin has to be at least 20% higher. 10% below, they will not accept. So your cash surplus before interest and installment payment should be at least 15 to 20%. If it is lower than this, you'll have to rework the entire DPR. Why I put it here in due diligence? Because when you do the DPR, you go by so many other factors which we discussed. This may get lost out. So this has to be also put in mind. Volatility of the cash flow is something that bankers feel is a financial risk, especially in seasonal products. So warehousing is the only way out, where a reasonable amount of supply goes on and on, even in a non-season. Now the ratios that are acceptable. See, one ratio is the norms, right? So below norms not acceptable. But along with the other risks, if the norms are met, even then the lender may have asked for a better ratio, because he is very cautious. He is lending money. He doesn't want to go into collaterals, and on equity, he has no collateral. So for him, it is essential that he goes into a higher levels of risk insulation. It may sound bad that I've met the norm, but if the other things that we discuss do not match up, they may ask for higher ratios or better ratios. I'm sorry, higher is not the word, better ratios. Now, the ratings of project owner's business, even if it is not connected with the project, is something that one looks into. CRISIL, CARE, their higher ratings are factored in as a part of risk assessment. While you're giving the promoter scanning, remember the banks have a way of looking at promoters scanning all across. Now, does the promoter have a reputational risk in business dealings? It can come out. Has there been any significant legal issues where the promoter stands to, has done something wrong or apparently wrong? This portion I faced, and it was terrible. After the DPR was done and all the thing was done, a family dispute started and a succession problem came, and the lending was stalled for one more year. In fact, in a VC matter, when I took it to the final stage, the VC went and asked the patriarch of the promoter, who was in his 80s, what's your succession plan? He refused to give. He had two sons. He refused to give who is going to be the MD. And the DPR did not go through, or rather, information memorandum didn't go through because it's too risky for them. Also, bankers look at one thing: how many diversion of funds have taken place, intercorporate deposits to their own subsidiaries or vague companies where they have interest. It's regarded as a no-no for evaluation. And finally, I mentioned the KMP, the key management personnel, how competent are they complete the project on schedule. In case there's a backup, in case the delay, are there any backup plans? Very difficult to say. This is an area I have also got stuck, but this is a question that comes up. The only thing you can say that I've got a second plan where I can pull in more resources, more people, but it's so difficult that this is an area that you have to negotiate your way out. I really have no answer. Okay, now this is the final slide. These are the documents that we see, that evaluators, the due diligence will see. First is the board resolution that the project is authorized by the board, and the fund requirement that has been put also authorized by the board, and if necessary by special resolution. In case of arrangement, now what happens, often you put in a DPR that I've got 5-6 customers who are ready to take my products, to assure the lender that the market is already sewed up. You need to show the MOUs, if not the mails, letters, correspondences with the so-called assured customers, so that the bankers feel that yes, at least to a short term or medium term, the market is tied up. Similar thing happens when supply of raw material takes place. Often to override the volatility of the prices, you take forward contracts. Now, are you in negotiation with those people for the quantity and price of the forward contracts? You have to give the letter, the mails to the bankers to evaluate. In case of site, you have to give land acquisition papers or leasehold papers. There should be no ambiguity in these papers. Otherwise, the lender will not lend till these papers are rectified. Same thing with the environment clearance certificate from proper agencies, pollution clearance certificate, and these are very important. Earlier, these were pushed to the background. Now, these are very important. Unfortunately, fire license still remains in the background, but you need to show that you have applied for. You need to have export-import clearance certificates. If you're accessing labor from contract suppliers, you must have a mail or contract or maybe MOU with the labor suppliers to show that that rate the labor is available. And finally, you need to serve negotiation docs and technology transfer. I mentioned this earlier. Capital assets. You need to actually show them various quotations for acquisition of the capital assets, because these are scrutinized very strongly by banks. Having said that, I would like to close this presentation. If there is any further questions, I'm willing to take it. Silva, is there any? Can we look at any further questions? Is there time? I don't think
Yes,
we got
we
time.
do have
Oh,
only
we got just 4 minutes.
6 minutes time, sir. So we have some 4 questions to be answered. I'll just share my screens.
Okay, now what do?
I'll share my screen.
Okay,
Is my screen visible?
right.
From 12 questions.
There's no doubt the Chinese products are looked down, but they're cheap. And unfortunately, Indian industry has become dependent. Not only India, the worldwide industry is dependent on them to make profits. Now, if you discourage them, then the profitability of the industries will go down. So it's a catch 22 situation, because they are giving you I'll tell you one example. One end, the glass, specs, the band around the specs. I saw 3 companies, my clients, they folded up because Chinese, well, they're supplying the bands at, I think, 18 rupees one band, they supplied at 9 rupees, and they closed down. But what happened? The specs manufacturer made profit because they had low rates. So it's a catch-22 situation. It is the ESG factor must come in, although somehow it is. I agree with you. It should come in, but somehow it's not, getting that favor. I think there's a pushback from the industry, but they'll also realize that this actually impacts them. Yeah, value chain helps, but it depends on the nature of the industry. If the value chain impacts a higher value, then there's a good thing. But normally what happens, people tend to hide this because they don't want to show this if the value chain is low. EV market, yes, I'm sure the bankers will look. I'll give the example. Indian market is not developed, but Tesla, which is the world's largest EV manufacturer, is fighting away the bankers from giving them loans. It has reached a situation they're just parking themselves in front of Tesla headquarters to give them loans. So that's what it is. I mean, because it's reached a critical level of production, they see the benefits coming. Unfortunately, in India, that's going to take a long time, because one thing, there's a pushback from the existing sector. Next is the charging stations are not developed. So you can't really go for long drives in an EV unless the charging structure is properly done. All right. If there's nothing, can we close it now?
Yes, it's over to second. Manoj. Yes.
Okay.
Thank you very much, sir. It was an extraordinarily lucid presentation, and the takeaway home thing is you did not repeat what's called the academic part of it. Your rich experience was embedded into your presentation, which is why you are the people who are the real assets of the institute, in my opinion.
Thank you so
Thank
much,
you
sir.
very much for your
It's a pleasure.
the practical exposure and sharing that exposure. Normally, many good chartered accountants, many very experienced chartered accountants would not be willing to speak, or even if they not be good at speaking. But we are very lucky to have you today. Even though most of us would have provided finance for our clientele through project reports, you have given a very professional and very wide approach, and very important thing is it is more relevant and contextual. That is very important part of your presentation,
sir. Thank you so much for your kind words.
Yes, sir. Thank you. And definitely members have been very enriched by seeing the queries that they have raised, despite this busy schedule of tax audit time.
I know.
Always
This
hear
I'm
We
surprised
always
that people
fear
have
to
been.
conduct such programs where most of the people would not be involved in project finance these days because of the recession and the slowdown in
Absolutely,
all these
absolutely.
things. And with the pressure of tax audits, number of participants would be lesser. But definitely your presentation will go a long way in alerting the members, in updating themselves and presenting these things in a very, very professional way.
So
And
thank you so much,
also,
sir.
you touched upon the attitude one should have during the negotiations, which is very, very touching, sir, because that presentation is very, very important, which is not with many of these CAs. We always are very transparent, but not very what's called window dressing in presentation is lesser in our
Yeah.
case. So
So
being
that has come out of my experience, and I've realized this is
yeah, that's
important.
what, sir. So your rich experience, your communication skills have been really unparalleled and also incomparable. Thank you very much on behalf of
Thank you, sir.
SIRC for your
Sir, I'm honored to
time.
be that I could share the ideas with you. I'm really honored that SIRC invited me, and I look forward to future such interactions. Thank you so much.
Thank you very much, sir. I also thank all the delegates for your participation despite your busy schedule. Each one of you have made our day today,
Thank you, sir.
and I also thank my chairman in absentia for choosing this topic and the speaker. Choosing the speaker also is so important. Seeing your presentation, sir. So I thank the CP committee for this, and also Selva for technical support, and the back office of SIRC for doing this memorable and very, very useful program. Thank you, one and all. Once again, thank you very much, sir.
Thank you.
Thank you.
So I'm exiting then. Thank you so much.
Thank you, sir.
Yes.